Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola and Malaysian palm oil.
Paris rapeseed. In late June, the market broke up and through and closed over a short-term upper wedge trend line and made a fresh onslaught higher, reaching the primary and secondary targets for this small descending expanding wedge pattern and rising in early July to make new highs not seen since July 2023, up to the congestion seen in September 2012 between 513 and 3/4 to 519 and a half. Once there, prices fell away, but only down to a little short of the 2013 high at 464 1/4 and the medium moving average currently at 477 3/4, reaching it 7 weeks ago. The market then saw a rise, the same week peaking at the congestion at 504 3/4 and just over the neckline extension of the June to October 2023 head and shoulders top currently at 502 1/2, only to fall away again with a small bear flag 5 weeks ago. Down below the medium moving average this time and under the dark blue highlighted lower bull channel line currently at 470 1/2 of the June to mid-August very wide bull channel. 3 weeks ago, something else developed, a July-based bearish shift pitchfork highlighted in bright red on my daily chart. I am not in love with this bearish pitchfork and I'm quite happy to retire if it becomes troublesome, but for now it still shows, if only just, the bearish angle of attack of this market. Prices they have since last Friday been testing the upper time overhead, currently at 468 1/2, as well as being corralled in between the gold long moving average below, currently 456 1/4, and the green short medium moving average, currently at 476, and the mauve medium moving average, currently at 477 1/2, both those last two overhead. There are two other features I'd like to highlight. The first one is for a fourth week, the late April to mid-August head and shoulders top. This utilizes the same dark blue lower channel line as its neckline. That's currently at 470 1/2. It is not a great looking example of a head and shoulders pattern. It's pretty ugly indeed, and it has so far not revealed whether it is a head and shoulders top or a head and shoulders continuation pattern, though today is once more being tested on the downside, or was when I started writing this. The second is the even more recent possible August into early September based reverse head and shoulders pattern with the purple neckline currently 474 3/4. I didn't think this could happen, but this second one is even more ugly and messy than the first. So, with the market moving around, we have an awful lot of resistances denoted by various colors on my daily chart between roughly 468 3/4 and 477 3/4. If prices do reject these resistances and turn lower, then apart from the gold long moving average below and the bright red middle time, currently at 447, we may have little away until the 50% absolute Fibonacci line at 445 1/2. The final observation is to do with these moving averages. Since the start of August, prices have been roughly corralled by the overhead medium moving average and green moving averages, green short medium moving averages, and below by the gold long moving average. It will be interesting to see what happens when prices finally do break out, not breach, but break out, properly break out of these restrictions. Winnipeg canola. There has been and is a lot going on here, as you can easily see. I'll do my best to interpret it. Towards the end of May, the market moved up, breaking through the long moving average, currently at 635.30, but soon after, running out of steam on the upside from the sheer effort of doing so. However, in the process, the month of May became a monthly key reversal up, a longer term bullish pattern that initially I suspected might influence the market, if not now, then in the future. However, since then I've had strong doubts. You see, June did not see any immediate resultant move higher. Instead, prices chose to drop, making lows at the end of the month not seen since the horn bottom of February. The fall was finally stifled by a 2-day pipe bottom made at the end of June, based on the May 2023 low at 611.10, and prices then zigged and zagged higher throughout July. The initial zig was up to the combination of the long moving average and the June 2021 low at 655.90. The subsequent zag down was to just over the May 2023 low, and the following zig back up was towards the May highs, just over the lesser Fibonacci line at 679 even. The next zag lower has been extended and saw prices rip down through all the moving averages, which had been far too close together for my liking, and I will deal with them shortly, but punching down through the 2021 low at 629.5, as well as the purple highlighted extension to the neckline for the April to June head and shoulders continuation pattern, currently 618.40, and the May 2023 low all the way down to the February 2024 low in mid-August, and just below it into a congestion between the December 2020 low at 567 and the February 2024 low at 575. All the earlier toing and froing created a wideish bull channel between late June to late July. The bull channel did not last, and I laid out 3 weeks ago the reasons why not, and I quote, "The first and most obvious is the previously mentioned concentration of the moving averages, all within a small area. Specifically, they have not acted as supports, and at most the long moving averages acted as a resistance back at the start of July. Personally, I suspected these moving averages to be maybe more of a nuisance than anything else right now. But we shall see," and that's the end of the quote. I said I would take time to deal with these moving averages again, and looking at them over the last 5 weeks, I have seen a new pattern emerge. Early 4 weeks ago, the market formed a bearish bow tie formation. Of the short medium moving average, currently 620.70, the medium moving average, currently 635.70, and the long moving average, currently 635.80. The only feature about them that is different is the moving averages entered the bow tie formation in the wrong order, though they have exited in the right order. Now, part of a bow tie formation is what it does at the beginning, but also some 15 to 20 sessions after formation. So at this latter time, there is usually a period of volatility and sometimes a further move in the direction of the bow tie. Thus, I warned you to watch out for any such action between the 28th of August and the 4th of September. Play my previous videos, you can see what I'm talking about. We are just exiting the significant period, and we can see not only the previously highlighted base building over August and a subsequent attempt higher up as far as the 2021 low at 629.60, but more importantly, the volatility and drop exhibited on Monday of this week, which together with Thursday and Friday of last week made a lopsided 3-day bearish evening doji star pattern. What is more, I drew 4 weeks ago a bearish Andrews pitchfork in dark blue for the late May to late July action. This had been a bit of a preemptive move on my part, but I felt obliged to show this, as this is showing the bearish angle of attack, especially where it has congregated around the middle time, currently at 566.20. Well, late last week, it showed how effective the dark blue upper time proved to be of this bearish pitchfork, and that's currently at 626.40 in capping the market, along with the help of the medium and long moving averages plus the 2021 low. It is not the end of any potential rallies, but with declining highs right now, the pressure on that 567 to 575 congestion zone below should not be underestimated. Bursa Malaysia crude palm oil. Back in February this year, we had a key break higher of what eventually became the bright red highlighted broken upper time below, currently at 37.62, of the August to November 2022 bearish shift pitchfork. I still keep this pitchfork on my daily chart because looking back, the market hesitated and built a base on this very thoroughly broken upper time. It did so again and again, and most recently throughout this past month of August. Closer to today, and the small reverse head and shoulders bottom over May had a green neckline extension, currently at 39.39. That is just below the current market. In early July, prices did rise, but soon fell away, leaving, if you include the changeover gap, an island top in the first week of July. However, the decline was stymied for a while during July, but in early August, we saw prices take a flyer on the downside, halting 4 weeks ago down around the same old bright red highlighted upper tine mentioned right at the start of this commentary. As I said earlier, during August the market built a base for a move higher, mainly between the lesser Fibonacci line below at 37.21 and the 50% Fibonacci line at 38.75. 2 weeks ago the market punched higher and closed over the long moving average, currently at 39.41. Over last week on this, prices have tried to stabilize over the long moving average and the green neckline, but so far are having a really hard time doing it, not managing to exploit the move higher in late August. In essence, prices are having a really hard time punching up through the lesser Fibonacci line at 40.29 and even closing over the congestion at 39.88. There's been enough that we might have formed a possible horn top variation on the double top over the last 3 weeks. However, I think the time to do that may have passed. We are currently above the main congestion between the short medium moving average, currently at 39.24, and the February 2011 high at 39.53. But the issue is the market keeps seemingly wanting to test these levels, and I suspect that one day it may give way. If it does, looking initially to the 50% Fibonacci line of the May 23 to April 24 move at 38.75, but do not be afraid of looking once again at the bright red broken upper tine below if it happens. Meanwhile, on the top side, keep an eye on a 39.88 congestion and a lesser Fibonacci line at 40.29. One final point, and has been a somewhat contrary point, but a point I've been stressing now for 24 weeks. I gave my thoughts back then on what was going on thus, and I quote, "So what now? Well, for this I went to my standby on such occasions, the longer term monthly charts, and there was one clear standout level that needed to be watched, and that was the November 2022 high of 44.08. This is a key level on the top side, because if it is broken, properly broken, then there are very significant potentials topside. Similarly, if it holds in that area, then there are significant potentials on the downside. So watch to see if prices reach up to the 44.08 area, and then what prices do at that level." End of the quote. For the moment, I would still consider monitoring this 44.08 level, as it is a longer term play.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.